Are you a high income earner and you feel like you're getting drowned in taxes? The reality is you probably are. The top 10% of Americans pay for 75%, give or take, of the total taxes that are paid into the US government. So what that means is that if you are a high income earner, you are quite rightly feeling like you are paying a ridiculous amount of money for your taxes every year. And that would be a true statement. What do we do about it? Is there a way to get around that, or is it just the plight that you're dealt with to pay so much of your income out in taxes? Well, this is where it's really important to understand the nature of what you're earning and whether or not there are ways to navigate the tax code to your benefit. The reality is that our tax code is very progressive in that as you progress through those codes, those brackets, as you make more money, you effectively pay a higher percentage of your money in taxes. But what's also true is that any of the places where there's availability for movement and for reduction of taxes, most of the time come from those individuals who are business owners, real estate investors, people that are outside of a normal waged job earning situation. And the reason for this is that the government has decided to incentivize specific types of earning in the US. And so what we have is a tax code that if you're a traditional W-2 earner, and you have a high income, you're actually going to have the least amount of availability for further deductions off that income. It's pretty unfortunate, but it's the reality is that you're just kind of stuck with it, right? You're getting this job, you have a great paying job, you're getting all this money through a W-2 from your employer, and maybe you have some perks and benefits that you can use at work. And I want to talk about those. But when people say, how do I save big money in taxes? The big savings really start to happen when you start to make alternative investments. And so what does an alternative investment look like? Well, it looks like businesses for a lot of people. So it's side hustles. It's starting separate businesses that are running alongside while you're trying to leave your day job and you're starting something. It's investing in real estate if done properly. It's potentially making investments into the stock market in certain, tax advantaged ways. So it's taking the earnings that you have and reallocating them or redeploying them back into the US system at large. And the reason the government incentivizes this is really where the majority for a long period of time. Now it's shrinking, but I'll still stay on the pro small business end. This is where the majority of jobs actually come from, is from the small business sector. And so the government rightly has a reason to incentivize people to take risks and start businesses in the US, because those individuals, those entrepreneurs, those founders, those dreamers, those people actually are responsible for a lot of employment and for further employing other people. So again, this is the relationship that the government has laid out to say, hey, if you go do some of these things, we're going to give you some extra benefits from a tax perspective to do that. And so this is where we see most people kind of win when it comes to taxes. What does that look like? So if I'm a traditional W-2 earner, the one thing I want to look at is what do I have available at my job? I want to make sure that if I have certain things that are available from a tax savings perspective, I take advantage of them. These are going to be looking at things like an IRA or a 401k. We're going to start there and look at your retirement options at work. These are also going to be things like an HSA, a health savings account, or an FSA, a flex spending account. We might have some other small benefits, supplemental insurances and stuff like that can be offset from our income. And usually in the FSA, sometimes we'll have like a dependent care credit or availability of funds that our employer will sponsor. Again, all of those, normally if we use those from our job, we're going to be able to offset current income for tax purposes by taking a reduction now through our employer. And all of that usually happens at the employee-employer level and all gets reflected on your W-2 at the end of the day. And so those are the main things that we want to make sure, if the ability to take some of those benefits is there and we're looking at reducing our taxes, let's start with what we have available. From there, we're not going to have as many things that we can write off against our total income. So there's a few things that we can look at. If we're a high income earner, we're going to start then, after we look at our at work benefits, we're going to look at what we have in the itemized deduction categories. And these are not going to be too many things. So where we have the ability to take deductions, if we're a high income earner and we itemize deductions, is we're going to look at things like mortgage interest. Okay, so the amount of interest we pay on our mortgage on our primary residence, that might be a deduction. We're going to look at our real estate taxes, and this is going to be really important for 2025 because the OB3 made some changes that is going to allow people to take more of a deduction for their real estate taxes. And then we're going to look at charitable contributions. So if you're somebody who's thinking, I would like to be charitable or give money to an organization, a qualified charitable organization, that's great. And that could be a tax deduction for you. So those are kind of the big three that I see my high income earners be able to take advantage of if they itemize. Whether or not they itemize is usually dependent on whether they're big givers or big spenders on their house. And so those two are the big triggers that usually push people into itemizing. After that, the number of things, although there's a few that we can do to offset that income, really become pretty small. And the reason for that is, again, the government actually has a lot of restrictions on high income earners. So the more money you make in our system, the less ability to take certain deductions because they start to put income limits in on things. And so it's sort of very difficult to navigate that if you're a high income W-2 earner. But where can you save money in taxes? Well, this is where the conversation starts about diversification. And so if you have a lot of income from a job, from a W-2 job, how can you offset it with other alternative things that you do? Well, we're going to look at two big things. The first would be businesses. And so we're talking our side hustles and our businesses that we maybe want to start to escape our main job and maybe build it up enough that that's where we want to exit to. But by having a small business outside of your W-2 job, there's traditionally going to be the ability to take some more deductions than what you would normally have if you were just traditionally employed. Okay, so these are going to be where we get into certain things like expenses for maybe portions of our cell phone and home office and other things that we're probably spending money on. But if we are now also having a business, and this is a legitimate business, right? We're pursuing income, and usually we have income. So we're not just like saying we have a business and not not doing anything and taking deductions. So we actually have to pursue income. There has to be a purpose here. But if we have a business, a small business, a side hustle kind of a thing, then we're going to be able to usually take some of the same deductions that we are already spending our money on if we're high income W-2 earners, but we're also going to be able to take it as a deduction against that side hustle income and maybe even offset some of our W-2 income. So again, you're not usually spending more money, but you are able to take certain things as deductions because they fall into the business category. And then the other big place that we're going to look is whether or not real estate is a smart investment for you. This one gets very complex. So if you're a high income W-2 earner, and when I say high income, I'm usually talking over $250,000, but for this conversation, it's actually $150,000. So if you're a higher income W-2 earner and you want to get into real estate, you have to play this game very strategically. And this is where it's really important that you work side by side with a good tax advisor who understands what this looks like, because all real estate is not created equal in this conversation, and all real estate does not produce the same tax benefit. So it's really important that you understand what you want to get into and what is available for you based on your personal facts and circumstances. But in general, the reason people love real estate and love to get into it from an investment perspective for tax purposes is that they get to use something called depreciation. Depreciation is essentially the ability on your tax return to take a deduction each year that you own a piece of property, even though you may not have spent those dollars against the property. And so this comes from the foundation of buying a fixed asset or a large piece of property. And then the IRS has prescribed certain rules for how we depreciate or write off the value of that asset over a period of time. And the reason this is so powerful is that frequently depreciation will allow, on paper, real estate income to create a loss. And so if we play this game correctly, we're able to take a loss on paper, offset that against our current year income, but we didn't actually lose money in cash. And so the cash flow for what we earned from the rental property and took as deductions that are, usual and normal for operating a rental property. Then the depreciation, we actually cash flow positive, but we tax return negative. And so this is why depreciation is so powerful when it comes to real estate investments. But again, the catch here is that you have to get into the right type of real estate for this to work for you. So this is not just like, hey, I want to go buy a rental property and run it, because what's going to happen is you might not be able to get these big losses that you were thinking. Again, depending on lots of circumstances about your personal situation. So you have to know how to play this game. And it quite honestly is a game. And so we help people do that, but this is what you have to do. You have to know how to play the game in order to get the right deductions. So you don't want to just go doing it and thinking that it's going to help you at the end of the day, if in fact it's not. So I don't know. I want to hear from you. Are you a high income earner who has found ways to diversify their earnings into different situations where you're able to reduce your overall tax liability? And if so, I want to hear about it. What are you doing and what's working for you? Or what questions do you have? What else can I answer about how it is that high income earners can offset their income in ways to make their tax burden lower?